It happened fast, too fast to be normal. Silver didn't drift lower, it didn't roll over gradually, and it didn't respond to some obvious piece of news. It dropped $6 in a matter of hours, violently, surgically, and at a speed that tells you this was never about price discovery. This was fear, and fear at the highest levels of the system. Because real markets don't move like this. Leveraged, controlled markets do. When you see a move this sharp, this coordinated, and this sudden, the question isn't who sold. The question is why they had to. Banks don't panic sell assets. They control unless something else is breaking. Silver didn't fall because it's weak. It fell because it was used as a release valve, a place where stress could be dumped quickly, aggressively, before it showed up somewhere far more dangerous. This wasn't retail traders hitting the sell button. This wasn't sentiment turning bearish. This was institutional positioning changing under pressure. When liquidity tightens, when collateral gets questioned, when margins get stressed, banks don't debate. They act. And silver is one of the first places they go because it's liquid, leveraged, and easy to move in size. So don't misunderstand what you just saw. This wasn't silver failing. This was the system blinking. And once you understand why the banks panicked, the drop stops looking bearish and starts looking like a warning. To understand why silver can drop $6 an hour, you first have to understand that silver is not priced the way most people think it is. It is not a simple market where physical supply meets physical demand and a fair price is discovered. Silver trades inside a financial structure built almost entirely on leverage, paper contracts, and timing. What you see on the screen is not the price of metal, it's the price of risk. And when risk needs to be reduced quickly, silver becomes a target. At the center of this structure is the paper-silver market. Futures contracts, options, swaps, and ETFs represent claims on silver, not silver itself. These claims can be created in unlimited quantities, completely detached from the amount of physical metal available. That's how silver is controlled. When price needs to move lower, paper supply is expanded aggressively. Contracts are dumped into thin liquidity, overwhelming buyers and triggering stop losses. The metal never changes hands, only promises do. This is why silver behaves differently from most commodities. In a normal market, a $6 drop would require a collapse in demand or a surge in physical supply. Neither happened here. Mines didn't suddenly produce more metal. Industry didn't suddenly stop needing silver. What changed was the willingness, or necessity, of financial players to unload paper exposure. That distinction is critical. Real metals don't crash, leveraged structures do. Silver is especially vulnerable because it trades in highly predictable windows. Low liquidity hours, overnight sessions, and moments when most participants are inactive are prime opportunities for price control. This isn't speculation, it's standard operating procedure. Algorithms are designed to sell when volume is thin, not when it's deep. A smaller amount of paper can move the price much farther, much faster. That's how $6 moves become possible without any fundamental trigger. But this drop was different in one important way. It was too fast and too large to be strategic. Controlled smashes are usually measured. They cap momentum, shake out weak hands, and reassert dominance. This move looked rushed, desperate, almost sloppy. That tells you it wasn't about teaching the market a lesson. It was about getting out of the way. When banks and large institutions manage silver, they do so with a clear goal: maintain order. Order means predictable ranges, controlled volatility, and the ability to intervene whenever price threatens to escape. That requires balance sheet capacity. It requires confidence. It requires liquidity. When those conditions disappear, the tools of control turn into liabilities. The silver market is heavily short, not because banks hate silver, but because short positions are how they supply liquidity and suppress volatility. Those shorts are normally hedged, rolled, and managed across time. But when stress appears elsewhere in the system, in bonds, currencies, or credit, those positions become dangerous. A rising silver price increases margin requirements. A volatile silver price increases risk, and when risk managers step in, strategy ends. This is when silver gets sold hard. Not because it's weak, but because it's liquid. Liquid assets are sold first in a crisis. They are used to raise cash, reduce exposure, and stabilize balance sheets. Silver sits in that category. It's tradable, leveraged, and responsive. That makes it a perfect pressure release valve when something breaks elsewhere. And here's the paradox. The more aggressively silver is smashed on paper, the more disconnected the paper price becomes from the physical reality. Lower prices don't eliminate demand. They intensify it. Industrial buyers step in. Physical investors accumulate. Premiums rise even as spot prices fall. The market fractures into two layers: a collapsing paper price and a tightening physical supply. This divergence is not a sign of health. It's a sign of stress. The paper market is trying to move risk away as fast as possible, while the physical market is quietly absorbing metal and locking it away. Each smash increases future pressure because it transfers more silver from weak hands to strong ones. That's why these moves are becoming more violent and less effective. Another critical factor is trust. The entire paper silver market depends on confidence that contracts will always be honored, rolled, or settled without issue. Violent moves damage that confidence. They expose how fragile the system really is. Participants begin to ask uncomfortable questions. Who is on the other side of this trade? Will liquidity be there next time? What happens if everyone wants out at once? When those questions arise, behavior changes. Liquidity providers widen spreads, market makers pull back. Volatility increases, and that volatility forces even more selling from leveraged players who can't tolerate the swings. It's a feedback loop, and silver is at the center of it. This is why the phrase price manipulation doesn't fully capture what's happening. This isn't about pushing price lower for profit. It's about managing systemic risk. Silver is used because it's flexible, responsive, and historically obedient. But obedience only lasts as long as the system is stable. A $6 drop in hours tells you stability is gone. It tells you control is being replaced by urgency. The banks didn't execute a clean suppression. They dumped exposure. And once dumping replaces management, the market enters a new phase. So when you look at this move, don't see weakness. See mechanics, see leverage being unwound, see balance sheets being protected, see a system using silver the way it ought. The real reason the banks panicked has nothing to do with silver itself. It has everything to do with what was happening around silver at the same time. Markets don't exist in isolation. Stress migrates. When pressure builds in one corner of the system, it has to be released somewhere else. And silver, because of its liquidity and leverage, becomes one of the fastest places to push that pressure out. The $6 drop wasn't the cause of the panic, it was the result of it. What triggered that panic was a sudden tightening of financial conditions. When funding becomes uncertain, when collateral starts to get questioned, when correlations between assets spike instead of diversify, risk managers step in aggressively. Banks don't wait for confirmation. They reduce exposure immediately. That's how modern financial systems are designed to survive. And silver sits high on the list of assets that get cut first when capital preservation becomes the priority. This is where margin stress enters the picture. Large banks and institutions operate with layers of leverage spread across futures, swaps, and derivatives. These positions are marked to market constantly. When volatility increases, margin requirements rise automatically. That means more cash must be posted fast. If that cash isn't readily available, positions must be reduced. There's no discretion, no debate. The system enforces it. Silver's volatility exploded in a very short window. That instantly raised margin demands for anyone short or heavily positioned. At the same time, other markets were flashing warning signs. Bond yields moving erratically, currency pairs losing stability, risk premiums widening. In that environment, holding leveraged exposure becomes a liability. Banks weren't trying to suppress silver. They were trying to survive a broader liquidity squeeze. When institutions need cash quickly, they don't sell what's illiquid. They sell what can be sold immediately. Silver futures fit that requirement perfectly. They trade around the clock. They're deep enough to absorb size until they aren't. And once selling starts, algorithms amplify it. Stops are triggered. Volatility feeds on itself. What begins as risk reduction turns into a cascade. This is why the move looked panicked rather than calculated. A controlled smash has a purpose. Cap price, discourage buying, restore order. This move had no elegance. It overshot. It broke levels violently. That's the signature of forced action. Someone wasn't choosing optimal execution. They were responding to constraints. Another critical piece of this puzzle is collateral quality. In times of stress, not all collateral is treated equally. Assets once considered safe suddenly receive higher haircuts. Treasuries, bonds, even highly rated instruments can lose their privileged status when volatility spikes. When that happens, institutions must post more collateral to support the same positions. That creates a scramble for cash. Silver positions, especially short positions, become dangerous in that environment. Rising volatility increases exposure, while falling prices don't necessarily reduce risk because of the speed of the move. Banks reduce positions not because they think silver is going lower, but because they can't afford to carry the risk any longer. There's also a psychological element that often gets ignored. Banks watch each other. Liquidity providers monitor participation. When one major player steps back, others follow. Nobody wants to be the last one standing in front of a falling market. The moment selling begins, it creates a signal. Something is wrong. That signal spreads faster than any news headline. This is why silver is often hit before the real problem becomes visible elsewhere. It's the canary in the financial system. It reacts first because it's sensitive to leverage and confidence. When silver moves violently, it's usually because something upstream has already broken or is about to. And here's the most important point. Panicked selling does not resolve stress. It redistributes it. By dumping silver exposure, banks buy time. They raise cash. They stabilize their books temporarily. But they don't fix the underlying issue. If anything, They make it worse by weakening confidence in market stability and increasing volatility. Every forced liquidation tightens conditions further. Volatility rises, liquidity thins, spreads widen. That feeds back into risk models, triggering even more reductions. It's a loop. And once that loop begins, it doesn't stop because silver has found a bottom. It stops when the broader system stabilizes or when intervention occurs. This is why looking at silver in isolation leads people to the wrong conclusion. They see a price drop and assume bearish fundamentals. In reality, the fundamentals didn't change. Industrial demand didn't disappear. Supply didn't surge. What changed was the urgency of capital needs elsewhere in the system. Banks panicked because their margin of error disappeared. When leverage is high and confidence is fragile, even small shocks can force large reactions. The silver drop was one of those reactions. Visible, violent, and misunderstood. So when you ask why the banks panicked, don't look at silver's chart. Look at the plumbing of the financial system. Look at liquidity, collateral, and confidence. Silver didn't cause the stress, it exposed it. And once stress is exposed, the market never goes back to behaving the way it did before. The most misunderstood part of this entire move is what comes after the panic. Many people assume that once silver has been smashed, the danger is past, that the banks have regained control, volatility will fade, and the market will return to business as usual. That assumption is exactly what makes this phase so dangerous, because aggressive selling doesn't resolve systemic stress, it compounds it. When silver is forced lower in a matter of hours, it creates the illusion of strength on the part of the institutions involved. It looks like control, it looks like dominance. In reality, it's the opposite. It's a sign that normal mechanisms no longer work. If banks could manage price gradually, they would. Sudden violent moves are a last resort. They are the financial equivalent of slamming on the brakes. Effective in the moment, destructive over time. Lower prices in a leveraged paper market do not reduce risk, they redistribute it. Every contract dumped at lower levels transfers exposure to another participant. But in a market already stressed, that exposure doesn't disappear. It concentrates. Strong hands step in. Physical buyers accumulate. The weakest positions are flushed out, leaving a smaller group holding larger risk. That makes the system more fragile, not less. There's also a critical mismatch between the paper market and the physical market that gets worse after a smash. Paper prices can be pushed down instantly. Physical supply cannot be increased instantly. When prices collapse, industrial buyers don't cancel orders, they accelerate them. Fabricators, manufacturers, and strategic buyers see opportunity and security. They lock in supply while it's cheap. That drains inventories faster and tightens the physical market just as the paper market is trying to offload risk. This is the paradox banks can't escape. Every time they force silver lower to relieve short-term pressure, they stimulate the very demand that threatens them long-term. They create a discount that invites accumulation. And once that metal leaves the market, once it's fabricated, consumed, or locked away, it doesn't come back easily. Supply destruction is permanent. Another consequence of violent moves is the erosion of trust. Markets function on the assumption that price changes are broadly rational and somewhat orderly. When participants see $6 moves in hours with no fundamental trigger, confidence erodes. Liquidity providers widen spreads. Market makers reduce size. Hedgers become cautious. That means the next time stress appears, there will be fewer participants willing to absorb it. Volatility increases structurally. This loss of trust also affects derivatives markets. Options become more expensive. Hedging costs rise. Risk managers demand tighter limits. That reduces overall liquidity and makes future moves even more extreme. The system becomes jumpier, less tolerant of imbalance, and more prone to sudden dislocations. What looked like a one-off panic becomes a new baseline. Banks also face a reputational problem. The more often they resort to aggressive selling, the more obvious it becomes that silver is being used as a pressure valve rather than traded on fundamentals. That realization changes behavior. Participants stop treating price drops as signals of weakness and start viewing them as opportunities or warnings. That shift undermines the effectiveness of future smashes. And then there's the issue of short positioning. Forced selling often increases net short exposure at lower prices. That may feel safer in the moment, but it creates a dangerous asymmetry. Upside risk becomes explosive. If price rebounds, margin requirements rise faster. Shorts that survive the initial panic are now more vulnerable, not less. The system trades short-term relief for long-term instability. The feedback loops don't stop there. Physical premiums begin to diverge from paper prices. Availability tightens. Delivery times extend. These signals don't always show up on a trading screen, but they matter far more than spot price. They indicate stress in the real supply chain, stress that paper selling cannot fix. This is why each violent move reduces the effectiveness of the next one. The market becomes conditioned. Participants expect instability. They prepare for it. Liquidity thins preemptively. That makes the next intervention require even more force, which causes even more damage. Control becomes increasingly expensive. At some point, the trade-off becomes unacceptable. The cost of maintaining the illusion of stability exceeds the benefit. That's when behavior changes again, not toward calm, but toward retreat. Participants step back. Volatility spikes. And the market enters a phase where price is no longer guided but discovered. So while the $6 drop may look like resolution, it's actually escalation. It deepens the structural imbalance between paper and physical markets. It accelerates the transfer of metal from weak hands to strong ones. It undermines confidence in price signals, and it raises the stakes for everyone involved. The banks didn't fix anything with this move. They bought time. And time in a market constrained by real-world supply and rising demand is not a neutral asset. It favors the physical side. It favors those who understand that violent price action is not a sign of weakness, but of stress reaching a breaking point. This is why the aftermath of the panic is more important than the panic itself. The damage isn't always visible immediately, but it's cumulative. And once enough of it accumulates, the system is forced into a resolution it can no longer delay. This brings us to the final and most important part of the story, what this moment actually means going forward, and why the silver market is now operating under a completely different set of rules than most people realize. Because once you understand this phase, you stop reacting emotionally to price drops and start recognizing them for what they really are, symptoms of a system that can no longer stabilize itself. What happened with that sudden $6 drop wasn't a reset. It was a signal that the old model is breaking down. For decades, the playbook was simple. If silver rose too fast, paper supply would flood the market, volatility would spike, weak hands would sell, and price would settle back into a predictable range. That model depended on one critical assumption, that confidence in paper claims would remain intact. That assumption is now eroding. Markets don't fail all at once. They fail in layers. First, volatility increases, then liquidity thins, then trust disappears. We are now firmly in that third stage. When participants no longer believe that price reflects reality, behavior changes. Hedgers hedge less, speculators step aside. Physical buyers ignore paper signals entirely. The market fragments. And once that fragmentation happens, control becomes almost impossible. This is why the banks panicked. Not because silver dropped, but because they had to force it to drop. A healthy system doesn't require emergency actions. It doesn't require sudden, aggressive interventions. When those appear, it's a confession, not of strength, but of fragility. It says the system cannot tolerate equilibrium. It can only survive through distortion, and distortion always has consequences. One of the most dangerous consequences is time compression. In stable markets, adjustments happen gradually. In unstable ones, pressure builds quietly and releases violently. That's what we're seeing now. Long periods of apparent calm followed by sudden, inexplicable moves. This is not randomness. It's stored energy being released because the system lacks flexibility. Another consequence is behavioral reversal. For years, investors were trained to sell silver rallies and fear silver drops. That conditioning is failing. Increasingly, drops are met with buying, not selling. Rallies are met with restraint, not euphoria. This inversion matters. It signals a shift from speculative behavior to strategic behavior. And strategic buyers are far more dangerous to paper systems because they don't respond to short-term incentives. Physical holders don't care about intraday volatility. Industrial users don't care about technical patterns. Sovereign buyers don't care about sentiment indicators. They care about supply security. Once those players dominate demand, price becomes less responsive to paper pressure. It doesn't stop moving. It stops listening. This is where the illusion of control finally collapses. The banks can still move the price, but they can't guide it. They can create shocks, but they can't shape outcomes. Each intervention produces unintended effects that weaken the system further. Each forced move educates the market. Each panic reveals more information than it conceals, and information, once revealed, cannot be taken back. The silver market is now teaching participants something uncomfortable. Price suppression is not stability. It is deferred instability. It works only as long as participants believe the deferral will last indefinitely. Once that belief cracks, the entire structure becomes vulnerable, not because of a single event, but because of cumulative doubt. This is why the most important shifts often happen quietly, not during rallies, but after sell-offs, not during headlines, but during reflection. The real change is in T happening on the chart. It S happening in how people interpret the chart. A $6 drop used to signal danger. Now it signals stress elsewhere. That is a profound psychological shift. From here, the path forward becomes nonlinear. Price movements will feel illogical. Volatility will cluster. Correlations will break. Silver may fall sharply one day and surge the next with no obvious catalyst. This is what markets look like when they are transitioning between regimes. Old rules fade before new ones fully form. And in these transitions, patience becomes power. Those who try to trade every move will be shaken out. Those who anchor themselves to narratives instead of structure will be confused. But those who understand that the system is reacting, not controlling, will recognize opportunity where others see chaos. This is no longer about predicting price. It's about understanding behavior, understanding incentives, understanding that the institutions involved are acting defensively, not offensively. They are responding to pressure, not creating advantage. And defensive systems eventually exhaust themselves. The irony is that the very actions meant to restore confidence accelerate its loss. Every violent move reinforces the idea that something is wrong. Every intervention confirms that price is being managed, not discovered. And once discovery becomes inevitable, the adjustment is rarely gentle. That's why this moment matters. Not because silver dropped $6, but because it revealed the limits of the system managing it. Those limits are now visible, and once limits are visible, they become focal points for stress. We are not at the end of this process. We are closer to the beginning. The market is shedding old assumptions. It is recalibrating risk. It is redistributing metal. These are slow processes punctuated by sudden events, and each event leaves the system more exposed than before. So, when you look at silver now, don't ask whether the price is up or down. Ask whether the system looks calm or strained. Ask whether actions appear confident or reactive. Ask whether interventions feel routine or desperate. Those answers will tell you far more than any technical indicator ever could. Because what we are witnessing isn't a price story, it's a confidence story. And once confidence breaks, it doesn't return easily. It migrates, it relocates, it finds refuge where promises are limited and supply is real. That is why this moment will be remembered, not for the drop itself, but for what it revealed. The model didn't just wobble, it showed its cracks. And now that those cracks are visible, the market will never see silver the same way again.